Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
That there, as I'm sure you are all aware, is Mr. Warren Buffett, the 92-year-old oracle of Omaha. He is the CEO of Berkshire Hathaway, one of the largest companies in the world. And the reason most people know his name is because he is the world's best investor.
Imagine a life where your money works for you, consistently generating income while you savor the sweet taste of liberty. That's the transformative power of dividends. You can escape the traditional rat race and embrace financial freedom by making a one-time investment in the right company. In this video, you'll discover the secrets to a life enriched by the steady flow of dividends, providing security, choices, and the luxury of living on your terms. With things getting a bit shaky in the economy, inflation going up, and talk of possible big job cuts, it's a good idea for everyone to think about having different ways to make money. Like passive income, where your money does the heavy lifting. Imagine having a backup plan for your finances. Investing in a world where your money does the work for you could be a game changer. You can invest in dividends and just stash it away for years. And when you kick back in retirement, it starts paying you. Warren Buffett, the big shot investor, raked in over $4 billion in dividends last year. Talk about easy money. It's one of his secret weapons. Dividends are a chill way to make money. Put your cash in the right company once, and the money rolls into your bank without you lifting a finger. The trick is to get stocks with safe, growing dividends and a good shot at growing in value. And the cherry on top is to get them at a sweet deal. It's a laid-back income plan. Warren Buffett, the investing legend, believes in the power of dividends in making money. However, for dividends to be a real game changer for passive income, you'll need a huge investment. We're talking about owning more than 20,000 to 25,000 shares in a high-yielding company. So to get there, you might have to put in a few $100,000. The real magic happens when you let compound interest work its charm by reinvesting those dividends into the same stock. You won't start seeing high returns until you've been at it for around 20 years and probably added more of your own money along the way. If you had $1 million, you could set up a portfolio that eventually brings in a dividend income ranging from $50,000 to $75,000 a year. Living off dividends in retirement is a powerful and straightforward idea. When the money you make from dividends can cover your living expenses, you're ready to retire. You can use the 3% rule to figure out how much money you need. For every dollar you plan to spend in retirement, aim to have about 33 times that amount saved up. So if you're spending $30,000 a year, you would want roughly $1 million invested at a 3% return. If your yearly expenses are $100,000, then you'd aim for around $3.3 million in income-generating assets. Building $1 million portfolio is a journey that demands time, patience, perseverance, and consistency. The key ingredients to reach that milestone are the dividend yield, the growth of those dividends, the amount you invest, and the duration you stay invested, all while keeping costs in check. Imagine it as a mix of smart investing, letting your money grow over time, and making sure you're not losing out on unnecessary expenses along the way. Warren Buffett's wealth isn't just about his investments growing in value. He's also scored big wins with dividend stocks. While he's known for picking quality companies that see market share and earnings grow, his yearly wins with dividend stocks are like a reliable paycheck. They roll in no matter what individual stocks are doing. Buffett sees passive income, like what he gets from these stocks, as a crucial part of long-term investing. It's turned his portfolio into a money-making machine. And the good news is, you don't need billions to start building your income-generating portfolio. Buffett's success story is impressive. leading Berkshire Hathaway to almost a 20% annual gain over 57 years, outperforming the S&P 500, which had a 9.9% gain in the same period. His strategy involves picking undervalued, solid companies and holding onto them for the long haul, many of which also pay dividends. Take Coca-Cola as an example. Buffett acquired 400 million shares over 7 years, ending in 1994, and still holds them today. Back in 1994, Coca-Cola's dividends to Berkshire Hathaway were $75 million, steadily growing to over $700 million last year. The beauty of it is that Buffett just had to sit back and own the shares. This shows the power of long-term investing and reliable dividends. Berkshire Hathaway is on track to rake in over $6 billion in dividend income in the next 12 months, and a big part of that comes from 5 stocks, including Coca-Cola. This shows that sticking with dividend stocks for the long term can be highly rewarding. Buffett, in his shareholder letter last year, expressed how the Coca-Cola dividends grew consistently, comparing it to something as certain as birthdays. This shows the reliability and growth potential of well-chosen dividend-paying stocks over time. Even if you initially collect a modest amount in passive income from a small investment in a stock, it can be the start of something huge. As the company raises its dividends, or if you continue to invest more in the stock over time, that income could grow. You might also think about reinvesting your dividend payments into the stock, building up your holdings, and setting the stage for larger dividend payments in the future. When choosing a top dividend stock, a good starting point is looking at stocks that have consistently raised their dividends for at least the past 50 years. This track record shows a commitment to rewarding shareholders, making it likely that they will continue to do so in the future. However, before making a decision, it's crucial to assess the company's financial health. Check recent earnings reports to ensure the company is not struggling to grow or burdened with debt. Pay close attention to free cash flow, the money a company has after covering its operating expenses and capital expenditures. Taking Coca-Cola, a favorite of Buffett, as an example, its free cash flow exceeds $9 billion and has generally been on an upward trend. This strong financial position suggests confidence in Coca-Cola's ability to sustain and increase its dividend. But don't choose a stock just because of its dividend alone. It's important to invest in a company only when you understand its business and feel positive about its future. This way, you can track how it's doing and make smart decisions about whether to stick with it, invest more, or sell. Dividend stocks are just one part of a balanced portfolio that suits your needs. If you're a careful investor aiming for passive income, you might lean towards dividend stocks. On the other hand, if you like taking risks, you might prefer young growth stocks and have fewer dividend stocks. Additionally, when you're dealing with dividends, it's like Warren Buffett says, diversity is your best friend. Think of it this way: don't put all your eggs in one basket. Investing is no cakewalk, just as Buffett rightly points out. His golden rule for investing is to avoid losing money. The second rule is the same as the first: avoid those losses. Protecting your money is a top priority, so you need to take some precautions. Spread your investments across different industries and sectors to play it safe during various economic ups and downs. He suggests having a long-term mindset, steering clear of frequent buying and selling. After all, his biggest successes have been investments held for decades. It's over time that you truly grasp the amazing power of compounding. Sure, big dividend yields might catch your eye, but what matters is a company's ability to keep increasing those dividends. It's like Warren Buffett says, a company with strong finances and room to grow is the real deal. So, when you're looking at dividend stocks, make sure to consider not just the current yield, but also the potential for future dividend growth. Also, reinvest those dividends, whether it's back into the same stocks or other promising dividend-paying opportunities. This strategy helps grow your holdings and boost your income over time. Dividends are a speedy and efficient way to achieve financial freedom. For a quick and easy path to living off dividends, consider exchange-traded funds. They let you benefit from both stock growth and those sweet dividend payments. Following Buffett's advice, focus on dividend stocks to build your portfolio. Look for the cream of the crop, companies known as aristocrats. These are the ones that have been consistently increasing dividends for at least 25 years. It's like building your house on a strong foundation. These businesses have shown a real commitment to keeping shareholders happy. Put your money in blue-chip companies, the big players that have weathered economic storms, boast substantial market capitalizations, and stood strong through tough times. These companies often dish out dependable dividends. If you're new to investing or short on time for individual stock research, consider dividend-focused ETFs. They're a convenient package deal, offering you a slice of those reliable dividends without the hassle. ETFs are a jackpot for diversification. They pool dividend-paying stocks from various industries. Some ETFs also sell call options on these stocks. These options allow others to buy the stocks at a set price during a specific time. Now, this is where the magic happens. If stock prices go up, the ETF can sell the stocks for a profit. ETFs isn't just investing in stocks, it's playing a bit of a strategic game. By writing call options on the stocks it holds, the ETF can benefit in two ways. If the call options get sold off, there's potential capital appreciation. But if stock prices rise past the call option strike price, the ETF has to sell those stocks. Additionally, DRIPs or dividend reinvestment plans let you automatically reinvest your dividends to buy more shares, often at a discount. It's like having your money work on autopilot, steadily growing your wealth. And the best part? It's a great way to secure a steady income during your retirement without breaking a sweat. All it takes is a sprinkle of patience and a dash of discipline to cook up success in the world of dividends. With this knowledge, whether you're starting small or have a lot to invest, you're ready to explore the world of dividend stocks. Just like Warren Buffett, you can slowly turn your portfolio into a money-making machine. Hey, if you enjoyed this video, like and subscribe for more valuable content. And thanks for watching.